Today I'm breaking down exactly why your taxes can surge once your income hits $100,000, and we're going to talk about what you can do to avoid it. As a CPA and the founder of a tax technology company, I've helped countless individuals navigate the complexities of the tax system. My expertise is in breaking down the tax code so that people like you can keep more of what you earn no matter how much money you make. Many people don't realize that earning $100,000 or more can trigger higher tax rates, additional taxes, and the loss of key deductions and credits. This often leaves them wondering, where did all my money go? But don't worry, I'm going to help you understand exactly what happens when you cross that $100,000 threshold and how you can minimize the impact on your finances. So let's get started and take a closer look. The first thing we want to talk about is what taxes occur once you hit $100,000. And the first thing to think about is that once you hit $100,000, you're typically jumping into another tax bracket. In that tax bracket, you're jumping in the 24% tax bracket if you're single and the 22% tax bracket if you're married. And I want to talk a little bit about how tax brackets work, because a lot of people say, oh, I'm jumping into another tax bracket, so that means that all my income is taxed at that higher rate. And that's not exactly how tax brackets work. Exactly, tax brackets actually work is your money is taxed in that bracket. So if you have money in the 10% tax bracket, that income in that 10% tax bracket is going to be taxed at 10%. And then once you jump up to the 12% tax bracket, that amount that jumps into the 12% tax bracket is going to be taxed at 12%, but not all of the income. So it's key to think about that once you hit that $100,000 mark, all income above that $100,000 is going to be taxed at that now higher tax bracket. Again, the 24% tax bracket if you're single and the 22% tax bracket if you're married. The other tax that we start to see once you hit that $100,000 is self-employment tax. Self-employment tax, especially if you're a sole proprietorship or a single member LLC, starts to balloon, and it starts to have such a bigger impact on that tax bill that you're facing at the end of the year. And so self-employment taxes is 15.3% of profit. Now, this is over and above those normal income tax rates that we're talking about, that 24%, that 22%. So as a sole proprietorship, a single member LLC, once you hit that money that you're making, that profit in your business is getting hit with both that higher tax bracket as well as 15.3% in self-employment taxes. And once you hit that $100,000, that self-employment tax bill just continues to balloon. Now, I also want to talk about kind of how is that handled when you're an employee versus when you're a business owner. So when you're an employee, you pay your normal income tax rate on your gross wages, and you also pay half of FICA taxes. So FICA taxes are essentially the same thing as self-employment taxes. It's roughly 15.3% on your income. But when you're an employee, your employer covers half of it, so 7.5% roughly, and then you cover half of it, 7.5%. So as an employee, you pay your normal income tax rate plus half of FICA taxes. But as a business owner, if you're set up as a sole proprietorship or single member LLC, you're going to pay your normal income tax rate plus all of self-employment taxes at 15%. You don't have that employer covering half of those taxes for you because you are the employer. You are that person that's doing that. And the other thing we want to talk about when we talk about this taxes, once you hit that $100,000 mark, is do not forget about state taxes, because that's over and above. Remember, we're talking about federal. Your federal income tax rate, the federal self-employment tax rate, but then there's also state taxes. So if we also want to factor that into those tax rates, and those are starting to increase as well once you hit that $100,000 mark. So I always say, this $100,000 a year in income mark is really when things start to climb up, really when you get into that bracket where you're paying much more in taxes, you're starting to feel that hit a lot more. And that's what we want to say, okay, why is this happening and how do I fix it? Now, there's some states that have no income tax, and that's great. So if you're in Florida or Texas, you don't have to worry about state income taxes, but there's other states on the other side that have high income tax, and that's going to be a big part of your planning. So think of states like California or New York. So once we talk about, okay, we're inching up to that $100,000 mark or way past it, we want to talk about why the increase. Why is this happening? And the main thing is it's a bigger dollar amount. So that hit that you're getting is going to hurt even worse. And so when you have higher income, it pushes you into higher tax brackets, which means you're paying more taxes on that. And also when you start to jump into this higher income level, you start to lose out on some credits and deductions. They start to phase out. So let's even look at some credits like the child tax credit. Once you hit income of $200,000 if you're single or $400,000 if you're married, those phase out. Let's look at the earned income credit. If you have income usually around like $50,000 or $60,000 or more, you're phased out of the earned income tax credit. So once you have a higher income, you start to lose out on some of these credits and different things like that. And as income increases even above $100,000, you dig into even higher tax brackets. So now we might be looking at potentially a 37% tax bracket just at the federal level. So again, higher income means higher tax bracket, means more of your earned money is being put away to the government, sending it away for taxes. There's also even additional tax rates. So, we look at the your normal ordinary income tax rate plus self-employment tax as a potential tax rate. Those are, things that are hitting you at $100,000. Once your income gets even higher, there might be additional taxes that come into play. One of those is additional Medicare tax. That's roughly 1%, just under 1%. And that starts to come into play once you hit income of $200,000 if you're single, or $250,000 if you're married. If you have investments and you have interest and different things, dividends, things like that you're earning, you might start to see the net investment income tax, which is just under 4%. And that starts to come in around, again, that $200,000 if you're single, or $250,000 if you're married. So now we're talking, as your income just continues to climb, we're talking about not only ordinary income tax rate increasing, we have self-employment tax that's starting to balloon, but now we're potentially paying additional Medicare tax and the net investment income tax. And so these are just taxes that continue to balloon. So we want to talk about how. How do we fix this? How do we get past this point? As our business is growing, that's a good thing. We shouldn't be talking about, we don't want to grow our business because that means more taxes. No, we want to talk about how do we grow our business, but then also pay less taxes. And so when we talk about this, really how your entity is structured will determine the type of tax you pay. So if you're a sole proprietorship or single member LLC, you're going to pay self-employment taxes on 100% of your income. That's that 15.3% on 100% of your income over and above your ordinary income tax rate. Now, you might have an LLC that you elect to be taxed as an S corporation. And if you're in that situation, now you only pay self-employment taxes on the reasonable salary that you need to take as an owner, but you avoid self-employment taxes on everything else. Now, you still pay your normal income tax rate on the profit of your business and your salary, but you avoid self-employment taxes on the non-salary portion of the income from your business. You might be organized as a C corporation, and then you have, taxes at the corporate level, and you also pay taxes, double taxation, when you withdraw or take a dividend of that money. So how your entity structure is set up will determine the type of taxes you pay. Now, when we talk to business owners, we often see a lot of mistakes that they're making, especially once they start to hit $100,000. We say that's kind of like here you have something legit, you have a solid business running, but then we start to see people making mistakes. And one mistake we see is that people underestimate their tax liability. They don't make estimated tax payments. So they're making all this money, but they underestimate how much they actually need to put away for taxes. Maybe they're putting 5% away and say, that'll cover my tax bill, because they're used to that at lower income levels. But now when they're hitting here, that's not enough. And so when tax time comes, they get faced with a big bill, and they're maybe on a payment plan to pay that bill. Well, guess what happens? They're on a payment plan to pay last year's taxes, but now they're gaining income again this year that they need to be putting estimated taxes into this year, but they don't have the funds because they're paying for last year's problem. That's what we call a snowball effect that we often see when people do not correctly estimate their tax liability or don't make estimated tax payments. Other mistakes that we see people make is not taking advantage of the tax deductions available to them. Oftentimes they think, I'm too small. I'm only making $100,000 a year. I'm too small. And that could not be further from the truth. We talk to business owners all the time. The same strategies that we're implementing for someone making $100,000 a year are the same strategies that we're implementing for someone making $1 million a year. There is never an area in a small business where you are too small to save on taxes. It's all about learning the strategies that are available to you. Remember, the government gives an incentive to business owners. The government wants business owners. Why? Because they create jobs. They grow the economy. And the more that we can do that is better for the government. And so they want people to be business owners. They want people to hire people. They want to grow the economy. And so what do they do to encourage people to become business owners? They create these tax advantages to them. And that's these tax deductions. That's what we talk about. That's what our goal is, to say, okay, we want to take these incentives that the government gives us and we want to bring them to you so that you can learn them and implement them in your business. Because guess what? The government doesn't implement them for you. The government doesn't come knocking on your door and say, hey, I see you didn't do this. We're just going to take care of that for you. No, the government doesn't do that. They put these things in the tax code, and it's your responsibility as a business owner to understand them and implement them. And that's what we're helping. The other problem that we see small business owners make, especially when they hit $100,000, is, again, just not doing tax planning. They just run their business, prepare and file their taxes, and keep going. They don't take a little bit of time. Doesn't take much time, but they don't take a little bit of time to do tax planning. And I hope, because you're here, that you're taking that step to do so. So the question is how do we avoid these taxes? Well, first I want to talk about the strategy of maximizing deductions. And when a lot of people hear maximizing deductions, they think, oh, go out and buy a car I don't need, but it's going to give me a tax deduction. Or go out and buy a new computer or a piece of equipment or all these different things that I don't really need, but it'll give me a tax deduction. And we say, no. We don't want people to do that, because let's say you spend $100 and you're in the 22% tax bracket. Sure, you spend $100, you're going to save on taxes $22. But guess what? You still spent $100,000. So you are out money. Now, maybe you got a discount on that thing that you bought because of the tax advantage, but you're still out money. And so when we talk about maximizing deductions, we're saying, let's look at the spending that you're already doing, but how can we find a business purpose for it, bring it in the business, and turn it from after-tax spending into pre-tax spending? That's our goal. So we look at things like the home office deduction. Nearly every business owner that comes through Tax Helm, we're talking about the home office deduction and finding a solution or a way to make the home office deduction work. No, it doesn't work 100% of the time, but I would say over 90% of small business owners likely have a way that they can have a home office deduction in their business. We talk about automobile. As a business owner, you're constantly doing things, driving places, meetings, picking things up, buying supplies, doing all these different things. We want to be taking advantage of that automobile deduction as part of that. We talk about meals. As a business owner, and I know this myself, we are always talking about our business. So how do we find that a business deduction? We just document it. When we're talking about business, even if we're having dinner with friends, family, we're talking about business. Maybe we're asking for referrals. Maybe we're an electrician and saying, hey, do you have any friends that could use some electrical work? Well, that's a business meal. Write on the meal, write on the receipt, who'd you meet with? Why'd you meet with them? What was the business discussion? Write on the receipt, take a picture of it, save it on file. That's a business deduction. We look at travel. How can we organize travel, or travel that you want to do anyways, around business activities? Maybe there's a conference going on that you can go to or you can present at, and then your family's there as well. When we talk about travel, in order for travel to be a business deduction, at least 4 hours, half the day has to be spent on business. Half of the day is 4 hours and 1 minute. So if you go to a conference from 8 to noon, you got your 4 hours in on that's a business day. The IRS doesn't care what you do after that. You go to the beach, you go to the amusement park, you go see family, you go do all these different things. The IRS doesn't care because you got your business day. So how can you organize business-related items around travel that you might already do? Visiting a client, attending conferences, visiting an employee, different things like that. We think every business should have a board set up for them that they advise on. Not only is this board going to help your business grow, keep you accountable, but now you're getting tax deductions for those board meetings. Maybe you're doing traveling for that. Everyone should be using cell phone, internet, all these different things. Maybe technology purchases, these computers, cameras, microphones, screens, all these different things are business deductions. So again, we always say, if you're swiping that card, think of, is there a business purpose for that? If so, let's run it. We also talk into different areas like hiring your kids in your business. This is one of my favorite strategies. If you have kids that are in the 8 to 18 range, you should definitely be hiring your kids in your business. There is so much power behind that, along with different tax strategies that we can combo with it. So that's this idea of maximizing deductions. How do we take spending that we're already going to do? We're going to support our kids. We're going to have our home no matter what. But now how do we turn some of that spending at least into a business deduction? The other thing that we see once people hit $100,000, and actually we kind of recommend it at $50,000 or more, is this idea of an S corporation. Remember, we said if you're set up as a sole proprietorship or a single member LLC, you're paying self-employment tax on 100% of your income. But if you're an S corporation, we avoid it on a portion of your income. If we elect S corp status on an LLC, we, instead of paying self-employment tax on 100% of our income, we split our income into two pieces. We have a salary portion and a dividend, distribution, owner draw piece. Now that reasonable salary that we're required to take by the IRS, we avoid self-employment taxes on, or we have to pay self-employment taxes on. It's called FICA taxes, but it's essentially self-employment taxes. But any income over and above that reasonable salary, we avoid self-employment taxes on. So let's say you're making $100,000 a year, and we determine a reasonable salary for you is $40,000. We're going to pay self-employment taxes on $40,000, but we just avoided it on $60,000. That's 15.3% of $60,000 that we avoided self-employment taxes. Think of what you could do with that extra money. So an S corporation is definitely a strategy we recommend once people start to hit that $50,000 or more, and especially at $100,000. You might look into retirement planning. Maybe we're funding a solo 401k or a simple IRA or a SEP IRA. So we want to look into retirement planning depending on how big your business is. But there's a lot of planning opportunities, and that's where our focus is. When we look at all these strategies, there's pros and cons to it. But I want to talk about something specifically. So many people are afraid of tax planning because they think they are cheating the government out of it. And that's simply not true. The government put these things in place as an incentive to you. It's your responsibility to learn it and implement it. Now, also, we want to talk about this as well. Learning tax strategies is great, but it doesn't provide any tax savings. You have to actually implement those strategies. And when we talk about implementation, we also talk about implementing versus correct implementation, because you can take a completely legal tax strategy, black and white in the IRS code, and make it illegal just because you implement it incorrectly. So it's important that once we know these strategies, once we go to put them in place, that we're doing it correctly. We are dotting our I's, we're crossing our T's, we have the correct documentation on file. So if the IRS ever came knocking, we have nothing to worry about because we provide our stuff to them and they move on saying, yes, this is legitimate. So once you hit $100,000, taxes will start to balloon, taxes will start to increase. And I hope that this serves as a reminder to you that you need to start tax planning. You need to start learning these strategies, and you need to start implementing, and not only just implementing, but correctly implementing these tax strategies in your business. Now, this video has explained to you exactly why taxes skyrocket after $100,000 and what you can do to avoid it. I've given you the exact playbook you need to implement this and start saving thousands of dollars. But you are likely going to come up against a lot of roadblocks and problems that I have not been able to discuss in such a short video. So if you want a team of experts to help you implement these strategies in your own life quickly, efficiently, in a way that is perfectly tailored to your situation, click the link in the description. It will take you to a page where you can sign up for our tax technology software, where we will take you by hand and help you implement these strategies into your business. See you in the next video.